Getting a building constructed is not the same thing as getting the deal stabilized, and that gap between those two moments is where a lot of investor expectations start to break. In this video, I want to walk you through how stabilization actually works on a CMHC eligible multifamily deal, and why the first 12 months after completion can quietly rewrite your returns, even when the deal looks solid on paper. If you're new here, I'm Darren from DK Wealth and Growth, and if you've been following along, you know we focus on disciplined multifamily investing, especially in markets like Edmonton. This is one of those topics where the difference between understanding the timeline and assuming it can materially change your outcome. Let's start at completion. The building is finished, units are ready, everything looks like it's done. But from an investment standpoint, this is actually where the real process begins, because at this stage, the property isn't stabilized, it's just available. That's the first disconnect. Completion gives you an asset, stabilization gives you a performing investment, and those two things don't happen at the same time. Next comes lease-up. Units start filling, tenants move in, revenue begins, but as we discussed last week, this is rarely a straight line. You adjust pricing, you offer incentives, you test demand. Occupancy builds gradually, not instantly. And here's another important distinction. High occupancy does not mean stabilization. You can reach 80 to 90% occupancy and still not be operating at the income level the pro forma assumed. That's where many investors think the deal works, when it hasn't fully proven itself yet. Then comes rent achievement. This is where the building needs to demonstrate it can consistently hit projected rents. And with CMHC, this matters directly because final loan proceeds are often tied to achieving stabilized income levels. If rents are below expectations or inconsistent, that can delay full funding. So now the timeline matters even more because the financing structure itself is tied to performance, not just completion. This is where timing risk becomes financial risk. Finally, you reach operational consistency. Property management stabilizes, tenant turnover smooths out, income becomes predictable, and this is where the deal starts to behave the way it was originally modeled. But here's the key. This usually takes time, often closer to 12 months of consistent performance. So the real insight is this. The deal doesn't prove itself at completion. It proves itself over time, and the stabilization timeline is what determines whether the projected returns actually materialize. If that timeline is longer than expected or the assumptions don't hold, your returns shift, not dramatically overnight, but meaningfully over that first year. If this kind of structured, timeline-based thinking around multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC eligible opportunities, not just at the point of purchase, but through the entire life cycle of the deal. And next week, I'm going to take this one step further and show you something that happens even earlier in the process. How to read an Edmonton corridor before you buy the building, and why location at the micro level often determines whether everything we just discussed works or doesn't. If you want to explore opportunities where these timelines and assumptions are already stress tested, you'll find links below where you can join the investor list or learn more. Thanks for watching, and I'll see you in the next video.